Hello and welcome once again to Intelligent Investment Today. This is the podcast where we explore the timeless principles of value investing. The ideas that help investors navigate markets, not only in times of prosperity, but also through periods of uncertainty, volatility and change. And today we turn our attention away from markets, away from headlines, and towards something more subtle, but no less important. We're going to talk about management. More specifically, how we should think about the people running the businesses that we invest in. Because when you buy a share in a business, you're not just buying a set of financial statements. You're placing trust in decisions, in judgment, in capital allocation. And yet, somewhat surprisingly, the father of value investing, Benjamin Graham, was deeply cautious about placing too much weight on management quality. He recognised its importance, certainly, but he also understood its limitations. And perhaps most memorably, he once reflected on how something as trivial as a moustache could influence his perception of a company executive. Now that might sound amusing, even irrelevant, but as we'll explore today, it reveals something profound about the way we think, how we judge, and how easily we can be led astray as investors. So, as ever, sit back, tune in, and get ready to take on board another lesson in value investing, as inspired by Benjamin Graham. To begin, we need to understand the context in which Graham was operating. This was a very different era of investing. Financial disclosure was less standardised. Markets were less efficient. Speculation was often rampant. And reliable information was harder to come by. In response to this environment, Graham developed an approach that was deliberately grounded in objectivity. He focused on what could be measured: balance sheets, earnings records, asset values. He sought to build an investment discipline based not on stories or impressions, but on facts. And this is important because it explains why he was so cautious about qualitative judgments, particularly when it came to management. Management quality, after all, is not something you can easily quantify. You cannot assign it a precise value. You cannot model it with certainty. And perhaps most importantly, you cannot observe it directly in its entirety. What you see as an investor is only a partial picture, a curated one. Executives present themselves in reports, in meetings, in interviews. But that presentation may not reflect reality. And Graham understood this very clearly. He recognised that investors are often tempted to form strong opinions about management, to believe that a particular CEO is exceptional, or trustworthy, or visionary. But he also recognised how fragile those judgments can be, because they are inevitably often based on limited information and influenced by factors that have little to do with actual performance. Which brings us to the famous anecdote. Benjamin Graham once admitted forming a negative impression of a company executive because of his moustache, not because of his decisions, not because of his track record, but because of the caterpillar hovering above his top lip. He said it put him off the scent. Now, on one level, this is simply a human moment, an acknowledgement that even highly disciplined investors are not immune to bias. But on another level, it serves as a warning. If something as superficial as a moustache can influence perception, then what else might? Charisma, confidence, the way someone speaks, the way they dress, the narratives they construct. All of these can shape our judgment, and yet none of them necessarily correlate with long-term business success. Graham's insight here is not that management doesn't matter. It is that our ability to assess management accurately is limited. And that limitation introduces risk. Because when we think we understand something that we do not fully understand, we are more likely to make mistakes. We may overestimate management competence, we may underestimate risk, and we may pay too high a price. This is why Graham's approach was, in many ways, deliberately conservative. He did not want the success of his investments to depend on making perfect judgments about the quality of the management team. So instead, he focused on building a margin of safety, a buffer between price and value, a level of protection that would allow for error, including errors in judgment about the people running the business. And this is a crucial point. Graham was not trying to identify perfect companies. He was trying to avoid permanent loss of capital. And in that context, the question becomes slightly different. It is no longer, is this management team exceptional? It becomes instead, is this business strong enough that it can perform adequately, even if the management is not exceptional? And that is a very different standard. It shifts the focus away from trying to predict brilliance and towards ensuring resilience. Now that does not mean that Graham ignored management entirely. Far from it. There was one aspect of management that he considered particularly important, and that was integrity. Because while ability may be difficult to assess, integrity determines how management behaves, how they treat shareholders, how they allocate capital, and whether they act in the interests of the owners or in their own interests. An honest management team may make mistakes, but a dishonest one can cause lasting damage. They can misallocate capital. They can obscure reality. They can prioritise short-term gains over long-term value. And so, while Graham was cautious about judging competence, he was very aware of the importance of trust. That said, even integrity is not easy to measure. It is not something that can be fully captured in financial statements. And so, once again, we return to the importance of humility, recognising what we know, and just as importantly, recognising what we do not know. This idea was later developed further by Warren Buffett, one of Graham's most famous students. Buffett placed greater emphasis on management quality, particularly in the context of high-quality businesses. But even he acknowledged the limits. He famously remarked that he prefers businesses that are so strong that even an incompetent manager could run them, because sooner or later one will. This is, in many ways, a continuation of Graham's thinking. It recognises that while good management is valuable, it is not something we can rely on indefinitely. People change, circumstances change, and even capable leaders can make poor decisions. So the business itself must be robust. It must have qualities that endure beyond any single individual. And this brings us to the modern context. Today, investors have more access to management than ever before. Unlike in Graham's day, we can listen to earnings calls, watch interviews, read detailed reports, and follow executives on social media. There is a sense, perhaps an illusion, of familiarity. We feel as though we know these individuals, especially the particularly high-profile ones. We hear them speak, we observe their mannerisms, and we form impressions. But the fundamental challenge remains. We're still observing from the outside. We're still seeing a curated version of reality, and the risk of misjudgment is still present. If anything, it may be greater, because the sheer volume of information can create overconfidence. We believe we understand more than we do, and that can lead us to place too much weight on qualitative factors and too much trust in our own interpretations. This is where Graham's caution remains highly relevant. His moustache anecdote, while seemingly trivial, serves as a reminder that we are human, that we are influenced by things we may not even be aware of, and that disciplined investing requires us to account for that. It requires us to build processes that reduce the impact of bias, to focus on what can be measured, to demand a margin of safety, and to avoid relying too heavily on factors that are uncertain. Because ultimately, investing is not about being right all the time. It is about avoiding being catastrophically wrong. And one of the ways we do that is by recognising the limits of our own judgment, especially when it comes to something as complex and as human as management. So the next time you find yourself being impressed by a CEO, or reassured by a confident presentation, or perhaps even being put off by something as trivial as appearance, it is worth pausing and asking a simple question. Am I assessing the business, or am I reacting to the individual? Because the distinction matters more than we might think. And that brings us to the end of this edition of Intelligent Investment today. I hope it's been fun, and that you've enjoyed this look into management quality, investor psychology, and the subtle lessons contained in one of the more human moments from Benjamin Graham. Do add it to your playlist and all that, so you'll know whenever a new edition lands. I'm David Coombs. This has been Intelligent Investment today. Until next time, stay safe and happy investing.